You have questions, we have answers. Back with another quick clip. We had a question that came in. This individual is trying to determine how much equity exposure they should have in their overall portfolio. And there's a rule of thumb out there that says, hey, to make that determination, you take 100 and subtract your age, and whatever's left over should be the amount of equity exposure you have in your portfolio. What are some of your thoughts around that rule of thumb or that approach?
Yeah, Brian, thank you. I like this question. I think these rules of thumb exist and last because they simplify an important concept. And in this case, that concept is that as your investment time horizon shrinks, you have less time to recover from transient price volatility. And so as this rule would imply, as somebody gets older, as their time horizon begins to narrow, they should have an ever decreasing allocation to equity in their portfolio because equities are higher volatility, higher risk investments. So I think it's a good rule in general, but I think it introduces a couple of challenges. And one of those would be we're living longer today. You know, on average, people are living a few years longer than they did just a couple of decades ago. And so such a rigid model like this could leave a portfolio with too high an allocation to fixed income where it's not achieving the rates of growth that are necessary to sustain the client over a longer horizon. The other consideration I think that would apply is that we've seen about 3 decades now of declining interest rates, lower rates of return on fixed assets. So if somebody in retirement is looking to generate a stream of income to meet expenses that they have, this rule of thumb might guide them to a portfolio that's just not able to do that in today's low interest rate world.
Yeah, those are excellent points. I also think, there's a philosophy potentially outdated, of course. But when you think about the day I retire, I need to move to a conservative portfolio. And maybe you do based on your risk tolerance and goals and things of that nature, but that should be what's driving it, not some arbitrary date. Because to your point, we are living, into our 80s, 90s, and a good handful into past that. So if that adage or if that rule of thumb is generally inadequate, right, because it doesn't necessarily align with or accomplish our goals and objectives, where do you start? How do you build portfolios? What's your theory around that?
Yeah, absolutely. And I think that's probably, the key to it is looking at the client's unique situation. And that's really where we start. We don't apply a rule of thumb. We're not using predetermined allocation models that fit an age group, but rather we're starting with the client and beginning there, putting together a retirement or cash flow projection that looks out over the next 10, 20, 30 years. So starting with assets today that the client has, stream of income, whatever that might be today and in retirement, expenses, both the base level spending as well as maybe aspirational spending goals that they have, and understanding what's their long-term objective, putting that plan together, projecting forward on a conservative set of assumptions around rates of return and inflation, and arriving at what we term to be their financial risk tolerance. And financial risk tolerance is essentially how much risk does a client need to take? How much growth does their portfolio need to achieve? And that is usually a very good starting point for us as to the percent of equity to be allocated within the portfolio. But we don't stop there. I think it's important also to consider what we term a client's emotional risk tolerance. And that is, in many ways, how much risk can they manage to take? How much are they comfortable with? Because if you have a client tossing and turning at night and worse, finds themselves in a really volatile moment with losses in their portfolio where they can't take it, and they're forced to sell, that can do irreparable damage to the long-term growth of the portfolio. So we need to reconcile the financial risk tolerance and the emotional risk tolerance.
Tony, I love the way you said that. I mean, it's one thing for us to use, the analytical side of our brain and say, well, we need X amount in order to achieve Y. But the reality is a lot of, the way we view money, it's very emotional. A lot of people make emotional decisions too. So to be able to bring those two together to ensure that, hey, you're on track, but importantly, you can sleep at night, that makes all the sense in the world. So the other thought, of course, is, when you think about these rules of thumb, I think we truly believe people's goals people's money, people's dreams, they probably shouldn't rely on that rule of thumb on things that are just so important in their lives. So really appreciate the answer. Appreciate you being on, and thanks for coming on today.
Thanks, Brian.
And if you or anyone else has questions they'd like answers to, they can feel free to email us at qa@marinerwealthadvisors.com. Thanks for watching.